So here we will see one example of short range cash budget. Okay, so let's see this. Okay, we are preparing a cash budget on monthly basis here. Let's read the example. The Standard Mercantile Corporation is a wholesaler and ends its fiscal year on December 31st. The following information is available regarding the company's operations. Prepare cash budget on monthly basis. So first, management believe in the pattern of last year's sale is a reasonable basis for estimating the current year. Sale of last year is follows. So management has given what is the sale of last year, and accordingly current year sale will remain the same as a last year, and the monthly sales amount has been given: Jan, Feb, March, April, May, June, etc. Okay, then second, the accounts receivable on December 31st last year total was rupees 3,80,000. Sales collections are generally made as follows: during the month of sale 60%, in subsequent month 30%, in second subsequent month 9%, and uncollectible 1%. Okay, so this is how the debtors collections are being made. Okay, that is receipts from the debtors. So if you take this Jan for example, okay, Jan, okay, total sale is how much? 3,60,000. So out of this total sale, what has happened is 60% will be collected in Jan, 30% in Feb, okay, 9% in March, and balance 1% is not collected at all. Okay, so out of 3,60,000, this is how the collections of the sale will be. Okay, 60% in Jan, so 3,60,000 into 60%, this will get it in Jan. Okay, then February, then 30%, and so on. Okay, so this is how we will have to prepare one working for receivables from collections from debtors. Okay, then purchase cost of goods average is 60% of selling price. The cost of inventory in hand as on December 31st of last year is 8,58,000, of which 30,000 is obsolete. Arrangement has been made to sell obsolete inventory in the January at half of its normal selling price. Okay, so here the purchased cost, here cost of inventory 30,000 is obsolete. Okay, so 30,000 is nothing but cost of good, that is 60% of a selling price. Okay, so we need to find out what is the selling price of this inventory, and out of that selling price, the total amount that will be received for this inventory is 50% of selling price. So there is some calculation which needs to be made. We'll prepare a next. The company wishes to maintain the inventory on the first of each month at the level of 3 months sale as determined by sales forecast for next 3 months, including your budget month. All the purchases for on 10th of the following month, okay, are paid for on 10th of the following month. Accounts payable for December 31st of last year is 3,70,000. Okay, so account payable of December last year, that is 3,70,000, it will be paid on 10th of the next month. Okay, so first what we need to do is we need to analyze what is the quantity that is required to be purchased at the particular month. Okay, for a particular month. So how will we calculate that? We need to calculate what is the inventory that is required to be maintained first, then on the, and then we have to reduce what is the opening stock of inventory that is there, and then how much will be the total purchases for that month, and accordingly we need to calculate what will be the accounts payable. Okay, and this accounts payable, whatever is the balance, will be paid on the 10th of the next month. Okay, Then fourth, recurring fixed expenses amount to rupees 1,20,000 per month, including depreciation of 20,000. Variable expense amount to 10% of the sales. Okay, payment of expenses are made as follows. So fixed expenses are given 1,20,000, but out of that 1,20,000, 20,000 is depreciation. So cash recurring expenses is rupees 1 lakh. Okay, and then variable expenses we need to calculate depending on the sales. Okay, and then the payment of expenses is made as follows, that is fixed expenses during the month and following month, variable expenses during the month of following month. So how it's it say for the month of Jan, okay, if 100 is our fixed expense, then out of that 55 will be paid in Jan and 45 will be paid in Feb. Similarly, in the month of Jan, if variable expense is 100 rupees, then 70%, that is 70 rupees will be paid in Jan, and 30%, that is 30 rupees will be paid in Feb. This is how you need to calculate recurring fixed and variable expense. Annual rates and tax in addition to above expenses amount to rupees 10,000 and are paid in two equal installments, September 30th and March 31st. So we need to calculate this 10,000. We need to consider this in the our monthly cash budget of September and March. Okay. Then 6, it is anticipated that a cash dividends of rupees 80,000 will be paid on the 15th day of last month of the year. Last month of the year is December, right? So 15th day of the last month of the year, the annual this dividend will be paid of 80,000. Okay. Then the next, during winter unusual advertising cost will be incurred. Okay, and there will be some payments of 10,000 in the month of Feb and March, so that has to be considered. Equipment replacements are made at 3,000 per month, and then accordingly it has an estimated life of 6 years. So even if estimated life of 6 years it has, we are making the cash budget here. So there is a cash outflow of 3,000 per month, so we have to consider it in our cash statement or cash budget statement. Then company's income tax for last year is 2,30,000. Advance tax paid is 2,10,000. The balance tax due will be paid in May. So for the month of May, there will be an outflow of how much? 2,30,000 minus 2,10,000, that is 20,000. Okay, tax is payable in advance in equal installments on June 15, September 15, December 15 on the basis of 50% of estimated profit. So this is for the current year how the tax is payable, right? So what we have to do is, first we have to find out how much is the estimated profit, and then 50% of estimated profit we have to calculate, and accordingly 3 equal installments the tax will be paid. So there will be some cash outflow of tax in the month of June, then September and December. Okay, so on December 31st of last year, the company had a bank loan of 80,000 unpaid balance. The loan requires a principal payment of 20,000 on the last day of each month plus interest at 0.5% per month on unpaid balance at the first day of the month. The entire balance is due on March 31st of the current year. Okay, so we have to see how much bank repayment that needs to be done. Okay, on the March 31st current year. Okay, we have to calculate how much loan we have to repay. Okay, so 20,000 and then the entire balance is due on the 31st current year, and then accordingly we need to calculate the interest of 0.5% per month also. Okay, then cash balance on the December 31st is given as 1,10,000. Prepare the cash budget for first 6 months. So before preparing a cash budget, we will first see what is a collection from the debtors. Okay, we will prepare all the working notes and then finally prepare a cash budget statement, monthly cash budget statement. Okay, so first working note is collection from the debtors. Okay, now if you see the second point, okay, it's given that sales collection are generally made as follows. Okay, so how is the sales collection? 60% is during the month of sale, then in subsequent month 30%, and in the second subsequent month 9%. So say if January sale is 3,60,000, so 60% of 3,60,000 is collected in Jan, 30% in Feb, and 9% in March, and 1% is not at all collected. So now this is the format of working note that I have prepared. Okay, now for the convenience, what I have done is all the sales, monthly sales, I have copied it here. Okay, so it's easy for us to calculate. Okay, now let's prepare a working note. What I have done is, now Jan collection. So what will be the Jan collection? 60% in month of the sale, that is whatever is the in month sale, 60% of that. Then 30% in subsequent month, 30% of sales, Jan sales will be collected in the month of Feb. Okay, and 9% in the second subsequent month, that is 9% of Jan sale will be collected in the month of March. Okay, so now let's prepare this working. Okay, so first, how much is the sale in the Jan? 3,60,000. So 60% of 3,60,000. How much that come to? 2,16,000. Okay. Then 30% in the subsequent month. That is 30% of Jan sale will be collected in the month of Feb. That is 3,60,000 into 30%. That is 1,08,000. Okay, and then 9% in the next subsequent one, that is 9% of Jan sale will be collected in the month of March, that comes to 32,400. 9% of 3,60,000. Okay, now the month of Feb, the sale is how much? 4,20,000. So 4,20,000, so 60% of 4,20,000. So 60% of 4,20,000 is 2,52,000. It will be collected in the month of Feb. Then in the month of March, that is subsequent month. Okay, so 4,20,000 into 30%. So that comes to 1,26,000, and 9% of 4,20,000 will be collected in the month of April, so that comes to 37,800. Now for the month of March, sale in the month of March is rupees 6 lakh. So out of 6 lakh, 60% will be collected in the month of March, that is 3,60,000. Then 30% in the month of April, that is 1,80,000, and 9% in the month of May, that is 54,000. Okay, then sales in the month of April, 5,40,000. So 60% of 5,40,000 will be collected in April, 3,24,000. 30% of 5,40,000 will be collected in the month of May, so that is 1,62,000, and 9% will be collected in the month of June. 9% of 5,40,000, that comes to 48,600. Okay, now for the month of May. Okay, month of May, what is the sale? 4,80,000. So 60% of 4,80,000 is 2,88,000, and 30% 1,44,000. 1,44,000, that is 30% of 4,80,000, and then balance 9% will be collected in the month of July. But since we are making a cash statement only for 6 months cash budget, okay, we won't do any calculations for the month of July. Now the month of June, 4 lakh. So out of 4 lakh, 60% will be collected in the month of June, and balance will be collected in the subsequent month, but we are not calculating that. Now this Jan, Feb. Now in the month of Jan, if you look, 60% in month of sale, that is 60% of Jan sale in the month of sale, then 30% in subsequent month, that is 30% of rupees 8 lakhs, that is December sale, okay, will be collected in the month of Jan. So 30% of 8 lakh is nothing but 2,40,000. Okay, 9% of second subsequent month, that is 9% of sale of November will be collected in the month of Jan. So 9% of 6 lakh, that is 54,000. Okay, now in the month of Feb, okay, month of Feb, 60% of sale of Feb will be collected in the same month, 30% of sale of Jan will be collected in the same month, and 9% of sale of December will be collected in the month of Feb, right? Subsequent month, that is 2 previous month. Okay, you have to calculate it back. So that will be 9% of 8 lakhs, so it is 72,000. Now if you total this, it comes to 5,10,000, 4,32,000, then 518,400, 541,100, 5,04,000, and 432,600. So these are the collections from the debtors for that particular months. Okay, so this needs to be incorporated in our cash budget. Now let's see what is the next one. Next point, purchased cost of goods average is 60% of selling price. Okay, so cost of inventory in hand as on December 31st of last year is 8,58,000, of which rupees 30,000 is obsolete. Arrangement has been made to sell obsolete inventory in the month of Jan at a half of its normal price. Okay, so we'll prepare one more working note. This is for working note number 2. Okay. Sale of obsolete inventory. Okay, so cost of obsolete inventory is 30,000. It's given, right? Now what is given is cost is 60% of selling price. Cost is 60% of selling price, that is 30,000 is 60% of selling price. So 30,000 is equal to 60 by 100 into selling price. So original selling price, okay, or normal selling price comes to 50,000. 30,000 into 100 divided by 60, that comes to 50,000. Now what is given is in point number 3 that the arrangement has been made to sell obsolete inventory, okay, at the half of its normal selling price. So inventory will be sold at half of its normal selling price, that is 50% of 50,000, 25,000. Okay, and in the month of Jan, so cash receipt, there will be receipt from cash sales, receipts from cash sales in the month of Jan. Okay, cash sales of obsolete inventory, so that will be how much? 50% of 50,000, so that comes to 25,000. Okay, so this is how you prepare a working note for sale of obsolete inventory. So now the next para in the third point, right? The company wishes to maintain the inventory on the first of each month at the level of 3 months sales as determined by sales forecast for the next 3 months, including the budget month. All the purchases are on the 10th of the following month, are paid for on the 10th of the following month, and accounts payable on 31st December is 3,70,000. So your creditors balance as on December 31st is 3,70,000. So it will be paid on 10th of Jan, right? 10th of the subsequent month. Now for all other months we need to find out what is the balance of the accounts payable. Okay, so balance of the accounts payable is equal to purchases of the last month. So to find out balance of the accounts payable, we need to find out what are the purchases that are required to be made in each and every month. Okay, so to find out the purchases, we need to find out what is the closing inventory, opening inventory, and what is the cost of goods sold for each and every month. Okay, so we'll just prepare a working note for this. Working note number 3. Okay, this is okay, working note number 3. Now in this working note number 3, so what has been given is your stock. Okay, stock at the beginning of the month. At the beginning of the month should be equal to, okay, sales of 3 months including current month. Okay, that is sale means cost. Okay, the sale not at a selling price, at a cost, at a cost, that is 60% of selling price. So for the month of Jan, if you want to take a stock, it will be your sales of Jan plus Feb plus March. Okay, total. Okay, so on 1st Jan, this is what is the stock that is required. So it has to be Jan, Feb and March, and then when you get the selling price, you have to multiply it by your cost, 60% to get a cost. Okay, so this is what is the stock that is required on the 1st Jan. Okay, so now let's prepare a statement. Okay, now here is the statement, and for our convenience I have copied the month and the amount of sales during that month. Okay, so first, stock required on the 1st of each month, we'll calculate that. Okay, that is how, what, 3 months sale including current month, right? So for the month of Jan, what it will be, 3,60,000 plus 4,20,000 plus 6 lakh, right? So that is 13,80,000. For the month of Feb, it will be 4,20,000 plus 6 lakhs plus 5,40,000. So that comes to 15,60,000. Then for the month of March, it will be 6 lakhs plus 5,40,000 plus 4,80,000. So that comes to 16,20,000. So for the month of April, it will be 5,40,000 plus 4,80,000 plus 4 lakh, right? So that comes to 14,20,000. Then for the month of May, it will be 4,80,000 plus 4 lakh plus 3,50,000. So that comes to 12,30,000. For the month of June, it will be 4 lakh plus 3,50,000 plus 5,50,000, right? So that comes to 13 lakhs. Okay, then for the month of July, since we need to calculate the closing stock in the month of June, so we are calculating something for the month of July also in this case. Okay, so for the month of July, it's 3,50,000 plus 5,50,000 plus 5 lakh. So that comes to 14 lakh. Now the stock required on the 1st of each month is at a selling price. Okay, so we need a stock at a cost. Okay, so cost is nothing but 60% of the above. Okay, so cost of stock required at the beginning of month. Okay, it's 60% of above, that is selling price, right? So 13,80,000 into 60%, that comes to 8,28,000. 15,60,000 into 60%, that comes to 9,36,000. And accordingly we calculate 60% of all the selling price. Okay, so this comes to 9,72,000. Then here it comes to 8,52,000. Then 7,38,000. Then 7,80,000 and 8,40,000. Okay, so now closing stock at the end of the month. Okay, closing stock at the end of month. Okay, now if you see, this is the opening stock for the month of the Feb that is required as on 1st Feb. So the closing stock for the end of the month will be 9,36,000. Okay, from here to here. Accordingly, for every month, closing stock will be 9,72,000 in the month of Feb, then 8,52,000 here. Okay, here 7,38,000. Okay, here 7,80,000 and here 8,40,000. Okay, so for month of July we need not calculate anything, right? So I'm not putting anything. Okay, only to calculate the closing stock for June, we have done this calculation in the month of July. Now we have to find out what are the purchases. Now you know the formula. See, cost of goods sold is equal to opening stock plus purchases minus closing stock. Okay, now in this case we have opening stock for every month, right? We have closing stock for every month, right? Purchases, okay, so purchases we don't have, right? Cost of goods sold, we can find out cost of goods sold from selling price. We have sales for each month, right? So cost is nothing but 60% of selling price, so we can find out cost of goods sold. So in short, purchases is equal to closing stock plus cost of goods sold minus opening stock. Okay, that will give you purchases for the month. Now closing stock we have got, right, for each month. Now what I'll do is add cost of goods sold, that is nothing but 60% of your sales in the month, correct? 60% of sales in the month. So cost of goods sold will be, see, for the month of Jan it will be 3,60,000 into 60%, so that comes to 2,16,000. Okay, so for the month of Feb it will be 60% of 4,20,000, so that comes to 2,52,000. For the month of March it will be 60% of 6 lakh, that comes to 3,60,000. For the month of April it will be 60% of 5,40,000, that comes to 3,24,000. For the month of May how much is for the month of May? 4,80,000 into 60%. So for the month of May it comes to 2,88,000, and for the month of June it is 4 lakh into 60%, that is 2,40,000. Okay, so this is what we have got. Okay, now what, to find out purchases we have to reduce opening stock. Okay, so opening stock for the month of Jan. Okay, so month of Jan, let's see here in our working note 3. Okay, the cost of inventory in hand as on 31st December was 8,58,000, out of which 30,000 is obsolete. So cost of inventory of normal goods as on 31st December is how much? 8,58,000 minus 30,000. So that comes to 8,28,000. So as of December, it's a closing stock. So 1st Jan, it's a opening stock for the month of Jan. So opening stock is how much? 8,58,000 minus 30,000. Okay, so 8,58,000 minus 30,000. So opening stock here will come as 8,28,000. Okay, so for the month of Feb, we have calculated it here, right? Here. So all this we are taking it. Okay, so how much does that come to? 9,36,000. Here it is 9,72,000. 8,52,000. Okay, then 7,38,000. 7,80,000. We have to reduce it. Okay, to find out the purchases. I'm just putting a bracket since we are reducing it. Okay, so balance whatever we are getting is purchases during the month. Okay, so for month of Jan it will be 9,36,000 plus 2,60,000 minus 8,28,000. So it comes to 3,24,000. Okay, then for the month of Feb it will be 9,72,000 plus 2,52,000 minus 9,36,000. So it will be 2,88,000. Month of March 2,40,000, 2,10,000, 3,30,000, and here it's 3 lakh. Okay, now payments to creditors. So what will be the payments to creditors? So in the month of Jan, okay, whatever was the balance as on December, we are making that payment. So what is the balance in the December? 3,70,000. You can see it in the third point. Okay, so that we will make it in Jan, right? That payment. So payment to creditors in the month of Jan is 3,70,000. In the month of Feb, how much are the purchases in the month of Jan? 3,24,000. So 3,24,000. Then in the month of March, how much is the purchases? So 2,88,000. Okay, so whatever are the purchases, we are making the payment in the subsequent month. Accordingly, 2,40,000, 2,10,000, and 3,30,000. So this is how we calculate payments to the creditors. Okay.